A slight deviation from our live speakers today. We are now joined by Saul Miller in Johannesburg. Hi, Saul. Can you hear me?
I can hear you. Can you hear me?
I can hear you perfectly. Thank you so much for coming through today. We really do look forward to hearing from you. So, without any further ado, take it away, Saul.
Great. Thanks very much. Thanks, everybody, for tuning in one day after the Easter weekend. I'm Saul Miller. I'm one of the portfolio managers for the Ned Group Investment Balance Fund, and I'll just take you through the fund and some of our key concerns regarding markets and portfolio positioning currently. So just a little bit of history on Truffle. If you don't know us, we've been around for over 14 years with 12 highly skilled investment professionals. All the portfolio managers have over 24 years of experience, and we're a little bit over 60 billion in AUM at the moment. This just shows you the performance of the fund over time. Fund's been around for over 10 years. It's got a fantastic track record on all time periods. The last year was a little bit tough for us, but coming right over the next quarter, as you can see. And just a quick comment on what's happened to the fund over the last quarter, what's worked, what hasn't worked. Banks have done nicely for us, as you're probably aware. SA has been in vogue at the moment, given that we have a positive current account, or we have positive terms of trade in terms of rising commodity prices. So the country benefits when we have higher commodity prices, given that we net exporters of commodities. And furthermore, given that a lot of emerging markets have been struggling, like China with their regulatory issues and Russia and Turkey and so on, we kind of are the place to be. So you've seen a lot of flows coming into SA, and that's obviously good for cyclical shares like banks, and that's done nicely for us. Diversifieds have also done well for us, particularly the likes of Glencore. We'll chat a little bit about commodities and the drivers of energy and commodity prices a little bit later, because we still maintain quite an overweight there. You can see Sasol's also done nicely for us. In terms of what has hurt us in the last quarter, we had quite an exposure to offshore European and UK banks with a rising risk of a recession in Europe, given what's happening in terms of the Ukraine conflict. Those type of shares have obviously come under pressure, so we were hurt a bit by that. We don't have a lot of Naspers and Prosus. We're not particularly positive on it, but we do have a little bit. There's obviously quite a big discount in Naspers and Prosus relative to Tencent. So we do have a little bit, and that unfortunately has hurt us. We haven't increased our exposure. We're under 2% currently as of today. And then obviously with slightly stronger currency and rates under pressure, you'll see some of our foreign cash and foreign bonds came under a little bit of pressure. So with that, just moving on to what our views are in terms of the global economy and SA and what some of the risks are. I'll just let me just go through the list that you can see on the slide. Obviously, the conflict is front of mind. The Ukraine conflict, that's pushed up tail risks quite dramatically. There's still a lot of uncertainty as to how things are going to unfold and how long the war is going to last. But obviously one of the effects that we've seen has been through inflation. You've got much higher commodity prices, higher food and energy and other commodities. That's obviously prolonging the inflationary pressures that we saw from supply chain issues and COVID. And obviously one of the risks now is around stagflation. And you've got all these higher costs that should hit profits at some stage, should hit global profits, and you've got inflationary pressures. So that's obviously a worry for markets. And given the inflationary pressures and the fact that some economies like the US are actually doing very well, you've got record low unemployment, it's not surprising that we are seeing a hawkish stance from the Fed and a willingness to push rates up quite aggressively. And that's also obviously a bit of a headwind to markets. I mean, on the positive side, you do have higher commodity prices that are benefiting from this pivot to green energy, as well as the conflict and sanctions pushing up commodity prices. That's positive for some of our miners. So we'll chat a little bit about that. And then finally, just a comment on SA. So let's go through that list. First of all, just the impact of the conflict on GDP growth. And you can see, and you'll probably see this through most sort of pundits that give forecasts on GDP. There seems to be about a 1% hit to global GDP, primarily as a result of much higher commodity prices due to sanctions. It's obviously worse in Europe, where they're far more exposed to Russian gas and energy, and it's a little bit less pronounced in a country like the US, which is a little bit more sheltered. And obviously, it's particularly dire for net importers of food, and particularly emerging markets that are quite poor. So by now, you're probably aware that Ukraine and Russia is part of the breadbasket of the world. They are together. They are major suppliers of very key commodities, and food is obviously one of them. So if you look at wheat, together they export around 30% of the world's wheat needs. They're a little bit less in maize or corn, which is sitting at just under 20, and they're also major in terms of fertilizer, which you need for growing food. So it's no surprise that we've seen rocketing food prices that are nearly up. If we look at the basics or maize and wheat, they're nearly up 100% of if we look at it as of a few years ago, and that will obviously feed through into other foods. You obviously use maize and corn in terms of feeding livestock, so it's not going to be surprising to see more and more inflationary pressures there in terms of meat and so on. And this is obviously a headwind for the world. And then in terms of energy, as you know, Russia is obviously a key provider of energy to Europe, but they're also big in coal. And so it's not surprising that we're seeing further upward price pressure on coal. So all of this feeding into inflation, which you can see here. I'm just showing you US inflation in light green. It had obviously been driven up quite a bit in the last year due to COVID and due to supply chain issues and higher freight rates. And now on top of that, we've got to contend with higher commodity prices as a result of the conflict. What's interesting is despite the massive rise in inflation, the bond markets are not discounting in a prolonged inflationary impact. And what you see in dark green is what's implied by bond markets. And it's really from years 5 to 10. And you can see that it's a little bit above where it's been historically at about sort of 2.2. It's actually just started moving up in the last 2 days. It's now at about 2.5, but it's not vastly out of line with history. So the market, or the bond market, assumes that inflation will come back in line over the long term. Obviously, the risk is that we don't get inflation back in line and that it rises further. And then you would obviously see that pressure in higher bond rates, which could be negative for markets. Now, aside from issues around the conflict and supply chain issues, which we think should be coming off, we've been worried about the more sticky aspects of inflation for quite some time. And one of them is in wages. So wages obviously a lot more sticky than commodity prices and freight rates and so on, and that has been rising, not unsurprisingly, given that you have unemployment levels as low as about 3.6%. So it's not surprising to see higher wages. Now, we mention wages because obviously that drives inflation. One of the things it's correlated to is shelter costs or rentals for housing. You can see that in the chart here. You can see a fairly reasonable correlation. If wages are sticky and they continue to hold, that obviously puts pressure on house prices and house rentals. And that matters because rentals are about nearly a third of CPI, so they are significant. So this is obviously one of the things that we worry about in terms of keeping inflation quite sticky, aside from higher commodity prices, which is another problem you have. Just touching on unemployment, which is driving wage prices, what you'll see here is that they certainly are low. Unemployment rates are certainly low relative to history at about 3.6%. What you'll also notice is that when unemployment starts to pick up from the trough, it generally keeps on going, and it is usually associated with a recession. So we think, the risk of a recession is certainly increasing. We're not saying it's going to happen in the next couple of months, but there's certainly a risk of that building in the next sort of year, which is a concern for us. And you can see pretty much whenever unemployment has risen from trough levels, it's usually been associated with recession. Generally, recessions are not good for markets, which is a concern. Just looking at interest rates or long-term interest rates, we break up the US 10-year interest rate into the inflation-linked component, or the real rate that you get from an inflation-linked bond. And then the difference between that and a normal fixed-rate bond is obviously your inflation expectation. That's what you see in dark green. That's been fairly stable over the last 25 odd years. What's really driven interest rates down has been real rates. And you can see as a result of COVID, they went quite negative, and that was obviously related also to not just to low rates, but also a lot of quantitative easing where the Fed was buying up bonds. Now, we think that's unsustainable. And as of today, you don't see it in the chart here, but real yields are already almost zero. I think they're about -11 as of this morning, -11 basis points. So That -1 that we've had for the last year seems to have at least gone to zero. We think over time, you should see real rates in excess of 1%. There's not really enough time to go into it, but I mean, one of the sort of views on what sustainable real rates should be is that they should be closer to economic growth or real economic growth, which would probably put you between 1.5% and 2%. And you can see that's certainly not high if we look at where they've been historically. If you look at the light green, you can see we started the period at nearly 3.5%. So we think there certainly is a risk for those real rates to rise, especially given that there's probably going to be less savings and more capex in the US economy. And in fact, in Europe, you've got very aged capital stock or fixed asset stock, and you need to see investment coming through. And that extra demand for funds puts upward pressure on rates. So we're worried about interest rates possibly rising from inflation, but certainly rising from higher real yields. You might not see it in the next month or so, given we've already had quite a move, but we would think over the next year, you may well see more of an upward increase in those real yields. And that is negative for markets, given that that's one of the inputs into the valuation of equity markets, and obviously bonds are an alternative to equity markets. So as bonds get cheaper, you would expect money to flow out of equity markets into bonds. So certainly a headwind for stock markets. Another headwind for markets, and particularly the S&P, which is what we're looking at here. We look at earnings. You can see current earnings going all the way back to the early 90s, and I've put them into real terms here. You can see currently the fairly high level that we're currently sitting at, and the expectations for the next 2.5 years. So what you can see is at this fairly extended base, we're expecting another substantial amount of growth over the next 2.5 years. You've not seen any negative revisions in earnings from the States, despite the fact that we've got much higher input costs. You've probably got consumers that might be under a bit of pressure, but you should certainly have profits of companies under a bit of pressure with these higher wages. And the fact that there's been a lot of excess spend on durable goods, on laptops and IT equipment and so on, and you would expect to see some fall off of that over time. None of that quite seems to be discounted into markets, so that's certainly a headwind. And if we look at the valuations of markets, they're certainly not especially cheap relative to history. We've got forward PEs relative to the last 10 years. And what's especially noticeable is that the growth parts of the market, and you can think of, your FANGs, for instance, look quite pricey relative to history. And obviously, this is the sector that's particularly sensitive to long-term interest rates. Should we see long-term interest rates rise, this is the sector that would take a bit of pain. And there's certainly no war premium, or not much of a war premium being discounted into markets. We know that risks have risen massively, or tail risks have risen massively as a result of this conflict, yet we're not seeing quite a lot of that being priced into markets at this stage. Interestingly, at the bottom, as we've had for quite some time, SA actually shows up as looking reasonably cheap, trading at about 74% of its sort of 10-year median. So that's also, that probably talks a bit to why we have we have a reasonable level of exposure to SA, some of it domestically and some of it mining, but we'll chat a bit more about that in a minute. Just looking at China and commodities, as you're all aware, China's been under huge pressure. We've seen their property markets come under a lot of pressure. This drive for common prosperity, although it is great in the medium to long term in terms of uplifting everybody in China and helping all consumers, it's not great for profits in the short term, as we've witnessed in Tencent and the education sector. And then obviously COVID has been a huge headwind for China as they've had these vicious lockdowns. So a lot of pressure on growth in China. The lever that they can pull is one of infrastructure spending and stimulus, and we think that is still to happen meaningfully, and that's obviously positive for commodity prices. The other thing that's positive for commodity prices is obviously this pivot towards green. The fact that Europe wants to wean itself off Russian energy further means more spend and a more drive into the green side of the economy, and that's obviously good for base metals. And you can see the expected growth in various base metals on the chart here, multiples of growth over the next 18 years. So that's obviously good for miners of copper like Glencore and Anglo American. Another factor is obviously this underinvestment in coal, which is a dirty energy, and that's also positive for coal prices over the medium to short term. So once again, that's obviously positive for the likes of a Glencore and some of our other miners that mine coal, and that really talks to our holdings, or our sizable holdings in shares like that. I have nothing new to really say about SA from what I would have said over the last year. We think the outlook is fairly muted for SA. You can see the three top bullet points that I have, where I have big question marks. We have yet to see any major economic reforms or any big moves in terms of infrastructure, fixed investment, helping load shedding. I mean, I, for one, had 23 hours of load shedding on the weekend. So these kind of things certainly need to be sorted out if we're going to change our fairly lackluster growth trajectory in SA. Prosecutions, obviously, another one, which also where we thought we were getting traction, but that certainly seems to be falling by the wayside. SA doing well because we are the cleanest dirty shirt in emerging markets. So money moving away from Russia, China, where do they go to? They want to go to EMs, which don't have those issues and that obviously benefit from higher commodity prices. So that talks to SA. That's been positive for us. It won't necessarily hold if we go into a global recession, but for the moment we seem okay. Really, the key issue with SA is we want to look for opportunities where things are cheap, where they're not pricing in some kind of fantastic economic growth. And in particular, we want the self-help stories. So the companies that are really not dependent on economic growth. And there have been quite a number in SA. You've got the likes of Investec that's been fixing itself and turning itself around. You've got Remgro that'll be unbundling assets. RMI is another one. We're going to see the unbundling of MMI and Discovery. And we've obviously seen quite an unlock there as a result of that. Momentum is a business that's turning itself around. In terms of COVID recovery shares, we've got the likes of our healthcare sector, where as COVID eases, you're obviously going to see more volumes coming back to hospitals, and we're already seeing an improvement there in terms of the recent trading update of Mediclinic, which has been doing nicely. And both Netcare and Mediclinic trading on very reasonable valuations. Other companies offering great value in SA would be the likes of some of our banks like Absa. It's back to an 8 dividend yield. You don't even need inflationary growth in those dividends to get a double-digit return, which is compelling. BAT, another company that should do well, British American Tobacco. It's also quite defensive. So if we do go into some kind of recession, that would obviously hold up quite well. And then I've spoken about the likes of some of our miners that we like. Just looking at the portfolio, not surprisingly, you see a fairly low exposure to equity at the moment, and it really talks to our concerns around valuations and all the risks that we've spoken about. So we've got quite a bit in cash, and we're just keeping our powder dry, which we will hopefully invest as opportunities present themselves. Our exposure offshore not particularly high, and that's certainly an area where we can increase our exposure as well going forward, as we see a bit of pressure on markets. And you can see mining and resources quite sizable at the bottom at 17%, really talking to our positive view on various commodity prices. Hopefully that gives you a bit of a sense of what's in the portfolio and what our views are in the future and where we want to be positioned. Thanks very much.
So thank you so much for that. That was very interesting. We have about 3 minutes for some questions. I'd like to ask you 2 questions, one from the audience and one from myself. The one from the audience goes a little bit like this. We've seen that over the quarter, you've increased your cash allocation within the portfolio. So the question is, how much of this is a function of the investments into the fund versus taking risk off the table and stocking up on dry powder for when opportunity comes to invest that money?
So certainly quite a bit of it is a dry powder issue. We are worried about risks as we've highlighted, from inflation to overvalued markets to an insufficient risk premium being priced into markets. So we have taken quite a bit off the table, but we're certainly looking for opportunities. And as we find things that are offering great value, we will certainly invest in them and up our equity exposure, or our real asset exposure.
Right. And then you have about 60 seconds. Let's see if you can do it to answer this one for me. We've recently seen that you have substituted first ranked for Absa. You have substituted first ranked for Absa and Nedbank and Standard Bank. So can you just briefly take us through your thinking in terms of that?
Sure. First Rand's a fantastic bank, fantastic business. It's just gotten too expensive. So we've been selling it down as it's continued to outperform, and we've just shifted it into some of the cheaper banks. We also put quite a lot into Investec, which is one of our very large holdings. But ABSA in particular, it was just got way too cheap. It's actually pulled back a little bit of late, and once again, it's cheap. So we're upping our exposure. We have upped our exposure there a little bit as well. We just think on an 8 dividend yield, very compelling. And I think FirstRand got to about a 5. So there was just too much of a valuation gap. ABSA also a bit of a self-help story. So, they seem to be getting their costs a bit more under control, getting a bit more market share back. So valuation and a bit of a self-help story with ABSA.
Thank you so much for that. Look, at Nedbank, we're not complaining. We appreciate that. Thank you so much for being with us.